So Australian financial products are often very different to American products. Can you explain to our audience what the PFIC form is?
Yes, PFIC. Passive Foreign Investment Company, if you're looking to get the actual words behind the acronym. But the acronym is helpful because it is the single biggest, in my opinion, single biggest problem that's out there, especially in Australia, because they're so pervasive here. So for lack of a better way to describe it, in the US, you might invest in mutual funds. And that's a pretty standard investment technique for financial planners in the US. And you'll do that on your own. You might do that through your 401k or your IRA. It's that pervasive. In Australia, very similar, except Australia's got its own mutual funds. Here they're called managed funds or exchange traded funds, ETFs. And there they are, the lifeblood and the staple of financial planning and for superannuation that's out there. And so for every managed fund or exchange traded fund in Australia, it meets the definition of a passive foreign investment company or PFIC. And so in many cases, if it's outside the super fund, you're likely going to have additional reporting requirements for each and every one of them in your US return.
Each ETF, not each. Yeah, not like everything in Vanguard, but if you've got like 6 ETFs in Vanguard, you have to separate reporting.
That's correct. And so there's 2 real big impacts for individuals. One, and which is obvious, is the cost of preparing a U.S. tax return goes much higher when those have to be reported. But 2, and this is what sometimes is not focused on as much, is the actual potential tax impact. And people look at this and say, how can that be? Australia is, generally speaking, got higher tax rates than the U.S. Why should that generate additional tax in the U.S. if that's the case? And the answer is, even at its best, what you can have with a PFIC is a change in timing of taxation, meaning that in Australia, you're waiting until you get distributions of income from those funds, as you would expect.
Yes.
In the U.S., oftentimes, it's not going to always necessarily be on distributions. It might be, and believe it or not, this might be the better answer, on the increase in value of the fund, even without being distributed. And so you can get income that's subject to tax in the U.S. before it's been subject to tax in Australia. And if it's long enough before, you might end up with a U.S. tax liability that doesn't get offset by the Australian tax.